Hello and welcome back to another episode of the BlockHash Podcast. We have another great episode for you today. Be sure to hit that subscribe button and follow wherever you are tuning in. Hold tight for just a second as we play a quick advertisement and countdown video while we wait for everyone to join. Thank you, and we hope that you enjoy the episode.
What's up, guys? Welcome back to another episode of BlockHash Exploring the Blockchain, episode 322. Here back for part two with Acquire. Again, here with Brian, the CEO, and Paul, a new face, the CTO, to talk about where they're at now with Acquire and some of the things they're working on here in 2023 and where they're going in the future. Guys, it's a pleasure to have you back. How you guys doing today?
Good, man. Thanks for having us. It has been a minute and a lot's definitely changed.
Absolutely. Guys, tell me a little bit about each of you. Brian, I'm sure everyone kind of knows a little bit about you, but maybe a quick little introduction. And Paul, would love to know a bit about you and your origins as well. Whoever wants to go first.
Yeah, I mean, I'll lead in for Paul. I'll tee him up really nicely here.
Thanks.
We met a little while ago during one of our growth phases. We were in the process of actually a pivot. We still have a core product in mind of bringing private equities to retail investors, but along the way, we discovered some massive problems across the private placement sector, especially within fund management, fund administration, getting those funds direct to investors. And I think that is a barrier to getting us to, your Robinhood of private placement assets, right? So we decided to, focus our energies and what we had built so far onto tools that, service asset managers, funds, private equity funds, venture capital funds, anybody bringing a private financial product direct to consumers, and bring them into the digital world, give them a blockchain underpinning for their shares. And a piece of that was really complicated. It's credentialing, it's regulation, it's compliance. And Paul and I met through an event that we throw here in Nashville for traditional finance people and the blockchain community here, people building on blockchain in various ways. And I guess I'll let Paul connect.
Yeah. So just so you know, Brian's kind of like a local celebrity in the blockchain space. I mean, people come, he won't say this, he'll never say this about himself, but whenever people have questions about what's happening, they go to Brian. And so he's kind of like the node of our little network here in the Nashville area in particular, and Tennessee in general. There's a lot of entrepreneurial spirit here. There's a lot going on inside of Nashville. Nashville's growing. It's kind of growing a lot like Austin, Texas. It feels a lot like that. There's a lot of healthcare tech startups here, and fintech starting to move in this area too because of the tax advantages of being in the Nashville area. So lots happening here. But specifically for me, I was actually working on a particular project where I was looking at potentially getting funding on a product that I was developing with some other people. And I'd heard about Brian's platform. I'm like, wow, I just not knowing exactly what the platform was about. I'm like, I would love to have a way to like maybe launch our product to get our funding rounds like kind of set up through his company, because it sounds like he's perfect fit for what we're trying to do. Anyway, as I got into the understanding how the product works and how it I'm like, wow, actually this thing that Brian's built is kind of cooler than the thing I was working on. And so I was like, wait a minute, Brian, maybe I can help you with like launch this thing and get it in where it needs to be. And I've been doing software for a very long time, 25 years, and I typically work in highly regulated spaces where to be competitive, you got to be like ultra compliant. And that's what Brian's trying to do. That's what we're trying to do at Acquire Invest. It's actually that compliance, being competitive in a compliant way can be a competitive discriminator in the market, because, you got to be able to, like, especially in this industry, you got to be really good at making sure the regulators are happy and that everyone's money is safe. And so I'm naturally drawn to that kind of work. And that's what we're doing now. And what we're building is something that our customers can definitely feel confident that they're in a safe place, that we're handling things in a compliant way, that it's just different than what you're hearing in a lot of places in the market now. So in a sense, we're kind of like building something that's a safe place, like an oasis in a desert right now is what we're building. And so I'm excited to talk about it.
Yeah, you guys definitely have a really unique approach, I think, especially considering the contagion that's happened in the last year across finance, just generally from, crypto to traditional banking and, hopefully nothing else after this, but who knows? But, that need for a safe place to go and a haven to invest and to diversify is very important for, I think, a lot of people today. And I know you mentioned, previously in the last episode, wanting to build that kind of Robin Hood for private equity, private placements, but now wanting to pivot a little bit and shift. Can you talk a bit more about what that shift kind of looks like for you guys?
Yeah. The goal, the end goal remains the same. It's going to take us a minute longer to get there, right? The network that is private equity, private markets is very fragmented and disconnected. It's still running on a lot of manual processes, even if there are some tools out there that allow you to automate certain things. It's very, compartmentalized. And what we found was getting private equity to retail investors at scale with cost efficiencies required to bring something to scale was actually a lot more complicated in this market than, it should be. We saw a lot more problems to fix along the way, and it will eventually end up leading to, that Robin Hood of private placements, right? For lack of a faster way to explain it. What we're doing now is focused on businesses. So it's a B2B product, allowing them to take their financial products direct to their investors, their consumers. So B2B2C. We are actually giving funds, asset managers, institutions, the ability to white label both a front end and a back end to manage onboarding of investors, document signing, transaction processing, linking bank accounts, and it all settles. Every investment into each product is settled using smart contracts. So we automate that settlement process, and in the process of doing so, we're able to embed best practices, rules and regulations, identity checks along the way. And that's managed through both off-chain and on-chain databases that work together, and they all kind of flow through the smart contract. So that gives us the ability to, as Paul mentioned earlier, create a, safer environment for investors and fund operators to, onboard people and get investment in, and ultimately just operate private markets. So that's kind of where the pivot came from, is how do we get these products into our market? This ended up being the solution. So
it's a really large market too. I mean, Brian, maybe you can better describe it than me, but people think of public markets and kind of what happens there all this. They don't really understand how large private markets are.
Yeah, I mean, well, there's a this is probably something that attracted Paul to it to begin with. I mean, the market really is massive. I mean, it is rivaling the size of our public markets. Like if you're buying Apple stock and all that stuff, it seems like those are the only investments you can get access to. Even funds that want to bring access to retail investors can do so through our B2B platform. Depends on how they file with the SEC and so on and so forth. But, in terms of the size, I think the private markets are so big because there's a lot of opportunity there. And typically high net worth individuals, companies, funds of funds, family offices, they like to invest in deals that outperform the market. And that typically sits inside of the private side, right? You're looking at private real estate deals, people that own NBA teams fractionally through LLCs that are managed by a family office. And that's a deal that's going to return you more than your average 8% over 10 years in the S&P 500. It just outperforms, so it grew very, very large, and due to rules and regulations kind of set forth by the SEC, at least here in the United States, and there are similar rules and governing bodies in other countries, that kind of placed a line in the sand between retail, public markets and, your typically accredited private markets. And we've seen kind of a blend between the two over the last, 6, 7, 8 years after the Jobs Act came out in 2015. And, you're seeing down market participants coming into high level private deals at lower dollar volumes, requiring a demand for, scalable technology and scalable solutions. So how do we continue to get that scalable in a way where, the big institutions can bring some of the best funds to market for a larger group of people? And initially it's a larger group of accredited investors at, $50,000, $100,000, $200,000 minimums. While there are some other venture capital funds, private equity funds that are looking at like minimums that are in the thousands, single digit thousands, which is very unique. So the technology really does span, the gamut of the private market.
Got it. Yeah. And I know the private market is very massive. I think bigger than most people really pay attention to, because retail investors only really pay attention to the public markets, buying Apple stock, buying Tesla stock, things like that, buying crypto. I don't think they understand how expansive it is. And getting into being a B to B to C model, does that add other additional layers of complexity in terms of compliance and regulations that you guys have to follow? Or what's that kind of like for you guys in terms of making sure that you're abiding by all the laws, but you're able to still go down this pathway?
Yeah, great question. There's actually layers to the compliance part, right? And specifically around, is it more complex for B2B to C versus something else? Just regular B2B or B2C. Public markets have, you have to go IPO to get into a public market typically, or doing a special purpose vehicle, acquisition vehicle. And those are going through some pretty heavy disclosures. You have to do a lot of due diligence. You're going through a big filtration process there. In the private markets, there's different rules and regulations that change the compliance required by each fund going to market based on how they file with the SEC. So Reg A Plus, for example, gives you the ability to solicit differently than into a different group of people that can invest than a 506A or B offering that's a regular Reg D, right? Which are basically accredited only investors within a certain jurisdiction, not even outside of the US. So with that in mind, we actually took the different rules and regulations. We said, how can we build this in a very simple automated way into the platform where all we need to do during the onboarding process with a client is, how did you file, right? They send us how they filed. We look at their PPM and we set up that account for them. So now they have a front end and a back end portal, front end facing investors, back end facing their team and the vendors that help them operate that fund. And, it really isn't that crazy for us, because once you kind of codify it, you just have to keep up with changing rules and regulations and make sure that it stays compliant. Ultimately, you have to have licenses. The funds have to have licenses to sell, they have to file certain things a certain way. And depending on how you file, it may change the level of licenses you have to have. So ultimately, our company only does verification on our clients to make sure that they are, filed correctly. They do have the right licenses. And beyond that, when you think about securities custody, transaction processing, what we've done is actually integrate institutional grade tools into the platform to make us go from kind of zero to institutional ready out of the gate. Which means we have custody through a bank and trust that specifically does custody for securities assets on the blockchain. And when you think about the banking side, where does the money go? Where does it sit? Does it stop somewhere and go somewhere else? Well, we use escrow accounts for many of our clients, and the money does fly into that escrow account, sits there, it's protected, it's independent of the bank. So, if the bank falls, it is under, the trust structure to where it has a beneficial owner. So, we've gone to great lengths to figure out how to insulate our system and make it repeatable for funds of any type to kind of, do the same action over and over again. They can bring 6-7 funds to market inside of their own platform, and you can actually invest directly into any of those funds without having to go through the same process 2, 3, 4 times. Just do it once. You onboard once and you're in, right? You can invest at any point in time at that point forward.
Yeah, I think you answered kind of my next question a little bit too, which was, what kind of safeguards do you kind of apply to help, make this system safe, whether it's institutional grade tools and custody and escrow or verification of clients? Is that kind of like a mix of different things for you that all comes together that makes this more safe and secure and trustworthy? Or do you guys do something even more unique?
It's definitely a mix. I mean, I'll let Paul talk a little bit about our architecture as well, because, technology, compliance, identity, protections, personally identifiable information, all of that stuff comes into play here. And we're doing it on behalf of individual businesses, isolating databases for each client. But yeah, I mean,
yeah, I can talk a bit about that. Yeah. So basically we're handling people's money. I mean, this is like a super important responsibility. We have to be extremely careful that we're 100% safe with how we handle it and how we track it and make sure that it ends up where it needs to end up. So a lot of what we're doing on the technology side is we're not just logging what happens, we're like capturing transactional information in multiple locations so that we can print out a complete history of everything that goes through the system and how it works and how people transact money. And we're doing it in a way that is fault tolerant. And I think what's really interesting, Brian, that you definitely should talk about is like in public markets, people think, oh, I just buy a stock or I just buy something. It's just like so easy but with private markets, it can be very different depending on the fund that you're trying to invest in. It may have special rules for participation in that fund. Like you have to be an accredited investor, or you have to, there's some other requirement. You have to be in the United States, or you have to have some other issue. It makes it the perfect use case for smart contracts, because you can actually take an investment, a security, and you can actually wrap it in a smart contract that has those rules baked in and allows you to transact compliantly with perfection without having to worry about stuff. And I think something very cool to talk about, Brian, if you got a second, is to talk about how clawbacks and burns work, because that's fascinating.
Yeah, most definitely. So without making it super technical, right? I guess we'll dig in on the mint burn clawback function and how that relates to, transfer restrictions. You've probably heard of mint and burn in a number of different types of blockchain applications. For us, maintaining a share that has the capability of remediation in the event that, for example, you commit a crime and your assets are frozen, or an individual goes through a divorce and they have to sell something. They're trying to sell it to somebody else that they can't sell it to, right? So you're on an exchange and it's checking basically who you are you say who you are you who you say you are, and right. Then what it's doing is saying, okay, we will allow or we will disallow this trade, or you have to complete another action before the trade occurs. So mint, burn, and clawback is the ability to remediate any number of issues, and the transfer restrictions kind of built into that token as well help us kind of prevent the need for even remediation. So there's kind of 2 layers there. If we've codified a lot of the potential issues that would require remediation, we have less need for remediation. Now, you could lose your wallet, someone could steal your stuff somehow, your account, and transfer it to their own account somewhere else on the internet, on some other digital wallet. The difference here is, number one, all of our securities sit in a bank and trust custodied wallet that bank operates and holds. So they're doing this on your behalf, much like anything else is done today. Same custody rules, just applied with one layer of technology. And then the mint burn clawback is we have to actually go to that person's wallet and say, this doesn't belong here. Let's burn it in your wallet and reissue it to Paul. So that's basically Brandon just stole Paul's stuff and we just stole it back from Brandon, gave it back to Paul, right? And that goes through, layers of checking before we actually do anything like this. It has to actually be done by a transfer agent, someone that's licensed to approve, disapprove, or remediate transactions. This isn't something that, I'm sitting here doing. I'm not a transfer agent personally. We have transfer agents we've linked into our system that help us, operate these specific functions within the confines of, the government's rules and regulation.
Yeah, I think the key takeaway on there is that there's a lot of fear in the market, especially around digital assets, that if I'm an uneducated user or a customer and I make a mistake, I could lose everything and it would be forever. But what we're building is we're building a platform that allows people to have a bit of fault tolerance there, that if mistakes are made, there's ways to remediate those mistakes. And it definitely is a process, it could be turned into a legal process depending on the scenario that we're in. But it's not, people can't come in and just steal your stuff and it's gone forever. There's ways of doing the right thing, and staying compliant. So that should make this platform and this what we're trying to do way more attractive to the average user who's trying to get into the digital space when it comes to securities.
Yeah, having those protections, having those guarantees, I think are very, very appetizing for a lot of people right now, especially given the climate. What do some of your clients and partners look like? Are they banks or funds? Are they exchanges? Are they other institutions? Who do you work with primarily?
So the short answer is anybody originating a private asset, right? That's taking that direct to investors. So, the slightly larger answer to that is, you have multifamily offices that operate both in private investments and public investments. We would be the technology that would run their privates, and that's how that works. Multifamily offices, family offices, venture capital funds, private equity funds, anybody that is bringing or packaging some sort of financial product and going direct to an investor with it. A lot of these people are seeking out distribution sources, better ways to distribute, not just better ways to operate, save time, and cost, which what we do is automate a lot of these functions that are just time consuming, right? That require a lot of touch points. It becomes a single source of truth and really allows them to take their business without the need of additional resources to another level, right? It allows them to scale to another level. Even if they don't want to scale to too many more investors, they can now add more funds without adding more personnel. That's kind of the goal. So that's kind of a little insight into who we are working with. The fund sizes, I guess, would be a good place to focus. I mean, really, there is a break point. If you're not raising more than $5 million, like this platform probably isn't the right version for you. Like this is targeted at, middle market to institutional level, funds. I think some will find value in doing the $5 million levels, but, we're going to be operating with funds of 50 million and up. Probably predominantly. This is traditional finance, and we're trying to bridge them into a more Web 2 plus Web 3 world. There's a little bridge between the two there. I think, when you're looking at massive funds of those sizes, actually, this is an interesting statistic when you think about it. Early stage funds are typically defined as 20 million to 100 million. Early stage. When you think about an early stage company or a late stage company or growth stage company, the average fund size, according to our target sales research, is 330 million in the United States. So if that gives you kind of a bearing of how many funds are out there, there's, I believe, more than 1,400 tracked firms in the United States, and of those firms, there's about 4 funds released per year or managed. So you end up with about, I think the statistic was around 5,400 funds are actively raising capital in a given year. So that there's a little bit about who how many people are out there as potential clients for us as well.
Yeah, it's not an overly surprising statistic, at least for me. But I think for normal people, they go, oh, $1 million is a lot of money, and $20 million I could never even imagine. But, in this world, 20 million is nothing for a fund. I mean, there's funds that are worth billions of dollars, and a normal fund, being worth hundreds of millions. So yeah, that makes a lot of sense. It's a good thing to point out. You guys also mentioned that you incorporate smart contracts into the system that you guys have. Do you have a preferential blockchain that you guys use for that? Or does it matter?
I think it matters a lot, actually. But Brian, go ahead and lead into it.
Yeah, I mean, I'm going to throw this out there. Depends on the client, right?
Mm-hmm.
Some clients want this to be private, and they may be institutional level, and they want to stay within a system that has some controls, and we can add that to this system. We port the contract into private blockchain. We currently sit on ERC 1404, and we utilize 3643 for some of these issuances as well. And we've added some key functionality that's unique to our system on top of those two protocols, but that's Ethereum blockchain. It's just widely used. It's easy to get in and out of. And I think that's what most of these funds are going to look for is, how many people can use it and how easily. So that's the default for us right now is Ethereum. But we do see a lot of really big ones like Avalanche, Algorand, a bunch of these that are moving towards the focus of traditional capital, traditional financial services. And, those are ones that we have the ability to launch on as well. Right now, they're not our default, though.
Yeah, Paul, would love to get your opinion on it as well, since you're the CTO. But is there, outside of Ethereum, maybe another blockchain that you guys want to consider in the future, or are you guys comfortable sitting with Ethereum and its current developments? I'm sure there's a lot of aspects and things to take into consideration.
I mean, yeah, it absolutely depends on the situation and the customer. But with Ethereum, you get the transparency, you get a real distributed ledger that everyone can see. And it kind of drives us closer in the community closer in terms of compliance because of the transparency. It just helps. Now, there's other customers, other people in the industry that are using private blockchains. Now, that there could be really good business cases for private blockchains, but for example, you're not paying as much gas fees. You're just much cheaper. But at the same time, you don't have the transparency. So maybe they have a business case where they don't want the transparency. Maybe they want to keep it internal. But in our case, I just think it's a really strong move that Brian and the team have already made. Just landing us on Ethereum to begin with as a default is just, that's the ultra compliant way you want to go, I think. And not you can't achieve compliance on a private blockchain, but it's just, why put customers through your own personal proprietary blockchain when you could be on the, something mainstream. Right. And I think it's a challenge. It depends on the customer, what they need. You could also work hybrid solutions where portions of it are on the Ethereum blockchain and portions are on a private blockchain, and you can actually split, where your business logic is and like where you put things and how the contracts are managed. You can do that in a hybrid blockchain in conjunction with just traditional transactional databases as well, like SQL databases.
Absolutely. That's a good point.
That's actually exactly where I was going to go next is It's not all on chain. There are inefficiencies when you just sit with an entirely on-chain process. Especially when you're thinking about regulations, compliance, having to finish or remediate transactions that sometimes require courts, right? The courts send down an action and you have to do something different with the tokens, where they sit, who owns them. That's where not just being on chain is actually very, very beneficial. But having on-chain as the ability to control the checks and balances within the system and automate things to remove the human process and human error from a lot of these functions is key. So, Paul has led, the team with one of our lead developers, Anthony, to, build a really unique identity system and a really unique system to hold a bunch of data off chain that is secure and reliant on the smart contract to call to it. So there's basically they're oracles, right? For those, also hyper nerds like me out there.
Yeah, at the end of the day, we have to make it cost effective for customers. If we had for every small little thing that they wanted to do had to be on chain, it would be cost prohibitive for them to even do the regular day-to-day business. So a lot of the things that happen that are kind of the administrative stuff, it needs to happen off chain. It needs to be logged and completely secure as it should be. But those milestone events, we can publish those to the public blockchain to and then we at the same time we have redundancy both on the on chain and off chain in both systems. So we have a way to compare that we're always in sync, which is like it adds an extra layer of confidence to what we're doing.
Absolutely. I think that's a good comparison of the two. A lot of people think that you have to do everything like on chain these days, but the reality is it's not always as efficient as you might think. So yeah, you make some good points. And I think a lot of companies might trend in that direction as well to take advantage of some of those benefits of off chain or side chain type of action. Last question before we start to wrap up. What is your guys's roadmap kind of look like the rest of the year or going into the near future for Acquire? What are some things that maybe you guys are working on or things that you want to share with people so they can, stay excited and kind of keep up with the development you guys got going on?
Yeah.
I mean, go ahead, Brian. If you want to, I can
go for it.
Okay. Yeah. So really, I mean, what we're getting into is, if you look at the Robinhood for private markets, it's to make that even happen. There's changes that have to happen in the industry and with people that are providing the funds to even allow this to even happen. So we're basically paving the runway for Robinhood for the private markets. And so we're looking at what are those pain points inside those offices where they're having to issue funds. Like, what are they? What makes it painful for them to actually deliver, securities at volume. And so there's things that are happening in the day-to-day work that they do that are administrative related efficiencies that we're creating and things that create incredible speed that they've never had before, and messaging tools that they've never had access to before. It's focusing on those pain points in that space right now to get those family offices, those VCs into a position where they can quickly issue securities on the market, get investors in there in the driver's seat and their money at work as fast as possible. So the roadmap that we're working on is around those efficiencies that are, in the issuing of funds and managing users and investors and communicating to users.
Yeah. Just to kind of put a layer on that, we have built an incredible product ready to, operate funds to a certain extent. That data model that we built on the base is a foundation. If you want to take an analogy of building a house, right? You end up with all the flourishes and the sweet little, touches on it at the end, but that foundation is there. We've started to build automations on top of that. So floor 1 is built. Floor 2, what we're going through over the next 6 to 10 months is actually, taking functions that currently exist that fund administrators do that take an exorbitant amount of time that are not automated in any systems that we're aware of and embed those into this system. And because we have the foundation we have and we built it with smart contracts in the base layer, it allows a lot of these functions to just flow through. And some of those are like, capital calls, bringing out tax statements, PCAP, calculating net asset value, pro rata shares. A lot of these things people do manually. Even if you can accept payment and get someone a settled, share into your account, that's only part of the fund process. There's this whole life cycle piece, and there's, evergreen funds, interval funds, and then there's your one-off funds. So these different types of funds have different pain points, and what we're building now is actually going to solve those pain points. We work directly with a few pilot clients and an incredible board of advisors who works at the highest level, in the financial services world. The former Blackstone, AllianceBernstein, PIMCO, Goldman, Deutsche Bank. We've identified things that, to be frank, they just hated doing when they worked there. Like what do I hate? Okay, let's build that, right? Because that's the thing that we're going to sell on. Not just saving people time, money, and personnel, but a little bit of energy along the way too.
Right, right. Where can people go if they want to learn more about Acquire, or if they want to learn from you guys? You guys seem to have a lot of knowledge in this side of finance. I think people would really enjoy listening to you guys' opinions. Are you guys on social media, on LinkedIn, on Twitter?
Yeah, definitely LinkedIn. We're all over LinkedIn. We've got our website's a direct link to us. Fill out a form there. You can get us in a heartbeat. It's actually right below me, acquireinvest.com. And then, I'd say our Twitter is somewhat active, sometimes more than others. Depends on how active we are in building. If we're heads down, I'm not posting as much, but you'll find some good stuff on our Twitter account as well. It's just at Acquire Invests with an S at the end.
Cool. Guys, I really appreciate the episode. It's been really great. Thank you for taking the time. Where can people go to learn more directly about Acquire? Should they just go to the website, or do you want to direct them to like a blog or a community? You tell me.
Yeah, definitely the website. It'll link to other places. Like we do have a Discord. We do have, like I said, the Twitter account. And we write some articles every once in a while and put them up in our Medium. We're probably going to be moving our Medium into a site hosted blog as well. But we try to keep it as central and simple as possible. Go to our website and click around. You'll definitely get a connect straight to us.
Awesome. We'll do. We'll be sure to share all the links and everything in the bio for the episode, as well as on social media. We'll be sure to push it out and tag you guys and make sure everyone knows. But thank you guys. Really appreciate it. It's been a really good episode, very technical, but learned a lot of things about, the private side of equity and finance and, the industry that you guys are in. So really appreciate it, guys, both of you.
Yeah. Thanks, Brandon. Appreciate it.
It's been great. See you in the next one.
See you in part 3.